Everyone, welcome to another video. So in this video, we'll try and understand all about the implications of GST on cigarettes and tobacco products. Now, the tobacco industry in India is one of the largest in the world with around 250 million users in the country. And because of the huge quantum, the government of India did definitely realize the potential and has levied heavy taxes on cigarettes and tobacco products right from the beginning. Because these are one of the rarest products on which you have both GST and central excise duty. Because normally from 2017 onwards, on almost all goods, you just have GST as a tax component only. But on cigarettes and tobacco products, which are termed as sin goods by the government, you have both GST and central excise duty, leading to double taxes. So the objective in this video is to understand the different types of GST rates on cigarettes and tobacco products, and B, to understand the methodology of valuation to find out on what value GST rate should be applied to find out the tax amount. So first things first, and that is about the GST rates on cigarettes and other tobacco products. We'll take cigarettes first. Now, prior to Feb 2026, the rate of GST for cigarettes was 28%. Plus, you had something called a GST compensation cess and an NCACD, which is a National Calamity Contingency Duty. Now, after Feb 2026, the rate of GST has been increased to 40%. Plus, you have NCCD, National Calamity Contingency Duty. So earlier, you had the concept of GST compensation cess, which is basically a cess that is levied so the states can get the compensation for the revenue or the money collected by the center. But after GST 2.0 came into picture in September 2025, the concept of compensation cess has been completely removed on all goods, not only on cigarettes, and therefore you only have GST and whatever allied taxes. So after Feb 2026, to align with the GST 2.0 concept brought about in September 25, for cigarettes, the rate of GST has been increased to 40%, along with NCCD, which is National Calamity Contingency Duty. So this is aligned with the objective of the government to levy heavy taxes on tobacco, heavy rate of GST on tobacco and tobacco products, on cigarettes and tobacco products, which are considered as sin goods under GST. Now, what about Bidis? Surprisingly for Bidis, the rate prior to Feb 2026 was higher than what is being charged now, that is after Feb 2026, which is now 80%. So from a 28% it has been slashed to 80%. Now, the reason would basically be for the government to give a boost to the unorganized sector, making these BDs on impetus to labor force behind making BDs in bulk. Having understood the rates prior to Feb 2026 and after February 2026 for both cigarettes and BDs, let us now look on to the most important part, that is a calculation of the valuation methodology for the purpose of computing GST and finding out what is the tax amount to be finally paid to the department or to the government. So first we'll take up what was the methodology earlier, and now after Feb 2026, what is the methodology being followed for the purpose of computing GST. Now, earlier GST was being computed like how it is being computed normally on all goods, that is on the transaction value or the taxable value. Let's say you have a wholesaler and he's selling it to retailer. Retailer is the recipient, wholesaler is supplier. The value of cigarettes, let's say in bulk, it comes to 1 lakh rupees. For example, 28% was the GST rate back then prior to Feb 2026 and therefore GST comes to 28,000 rupees. So taxable value being 1 lakh plus tax amount being 28,000 comes to 1,28,000 rupees, which the retailer the recipient will have to pay the supplier or the wholesaler. So earlier GST rate of 28% was being applied on the transaction value, like how it is commonly done for almost all goods for the purpose of applying GST rates. But now as we speak, this method has been completely changed. Specifically for cigarettes and tobacco products, you have to follow something called the retail sales price method. Now, this retail sales price method is a bit complicated, and therefore we'll simplify it with the help of a simple example where we will take the case of a manufacturer selling cigarettes to the wholesaler, wholesaler selling cigarettes to retailer, and then retailer selling cigarettes finally to the consumer, who is the final person going to the shop and buying a packet of cigarettes. So let's understand RSP through the help of an example. Say you have stage one, where the goods or cigarettes are being supplied by the manufacturer to the wholesaler. Now, the manufacturer, his job is to manufacture cigarettes, pack it, and put a sticker which has MRP or RSP on it. And let's say in this example, it is rupees 100 per pack. Now, he is making 1,000 packets, and therefore the value of that comes to 1 lakh rupees. This is the RSP, or the retail sales price, or the MRP for the 1,000 packets. Now, what the government said with respect to valuation or the method of computing GST through an advisory, what it said is that as far as the RSP, retail sales price method, is concerned, GST should be calculated as if it is included in the 1 lakh rupees. So the formula is 1 lakh into GST 40, which represents 40% GST, by 100 plus 40, 140. So 1 lakh into 40 by 140 will give you 28,571.43, which is the GST amount that the manufacturer will have to upfront pay to the department. So the government here through the advisory said that, look, I will ensure that the GST is being collected at the first chain of supply itself, at the first stage itself. So therefore, calculate GST on calculate GST under this method called the retail sales price method, where it is assumed to be included. So it will be 1 lakh into 40 by 140, so 20,571.43, and pay this to me upfront. Now, if 28,571.43 is a GST, then obviously the deemed taxable value will be 1 lakh minus this amount, which is 71,428.57. And if you add both these together, you will get 1 lakh rupees. So under the retail sales price method, unlike earlier, you just cannot apply a 40% GST rate, which is the rate applicable now, into the transaction value 1 lakh. No, that is not how it is to be done now. Now the retail sales price method is to be followed, where you calculate GST as if it is included in the 1 lakh rupees, so 1 lakh into 40 by 140, and the deemed taxable value will be lower than 1 lakh, which is 71,420.57. Now this 28, which will be 71,420.57. Now this 28,571.43, which is the value of GST, would be the fixed amount of GST that this manufacturer will have to pay to the government. And the government says that this is a GST that will be applicable at every stage for the purpose of computing the invoice value which the recipient will have to pay to the supplier. Let's look further. So continuing with stage one, we had the manufacturer supplying goods to the wholesaler. Now, if the making cost is, let's say, 1 lakh and all that, I mean, the total MRP or retail sales price is 1 lakh, he will definitely give it at a discount to the wholesaler because he's selling in bulk. And let's say the net selling price after discount works out to 60,000 rupees. Now, normally since 40% rate is the GST rate applicable now, you would apply 40% to 60,000 rupees and get a 24,000 rupees. But this is not how you should compute GST. RSP method says that, look, in the previous stage, you have already computed GST 28,571.43, and therefore that will be the GST amount that will be applicable to calculate the invoice value. So 60,000 plus 28,571.43, 88,571.43 will be the invoice value which the wholesaler will have to finally pay the manufacturer. So he will pay 88K, which includes 28K of GST, because 60K is the net selling price. You cannot apply 40% of 60,000 to get GST. You have to consider the GST that is fixed or paid in the earlier page when I explained to you. This 28,571.43 the GST upfront paid to the department, and that will be applicable for every stage. So to compute the invoice value, it's 60 plus 28K is 88K, and that will be the final price the wholesaler will pay the manufacturer. So this tax will be paid to the manufacturer, and then the manufacturer will collect this 28K and pay it to the department, like how we saw in this particular example. Now, this 28K, the wholesaler can very well take it as its input tax credit and then pass it on to the next stage. At stage 2, you have a case where the wholesaler is selling packet of cigarettes to the retailer. If 60,000 was the net selling price in the previous stage, he's putting a margin, let's say he's selling it at 75,000 rupees. Now you straight away cannot apply a 40% to the 75. That was the old method. You have to follow the RSP method where the GST amount is already fixed at the first stage of the supply chain itself, and therefore 75,000 rupees plus 28,571.43, this comes to 1,351,571.43 rupees, which is the invoice value that the retailer will pay the wholesaler. So again, like in the previous stage, the wholesaler will sell it at 75,000 rupees, which is the net selling price. Plus, he will have to charge GST. Instead of applying 40% on 75, he'll have to add the GST amount of 28,571.43, which was calculated in the first stage and fixed. And then this is the 1,03,571.43 would be the final value or the invoice value that the retailer will pay the wholesaler. And coming finally to stage 3, where you have the retailer selling it to the final consumer who walks into the shop and buys a couple of 2 packs of cigarettes. The retailer will only charge, let's say, the pack of in our example, the MRP of 1 pack is rupees 100. So the consumer, if he's going into the shop and buying 1 packet, he is only bound to pay 100 rupees to the retailer. And in this 100, the GST amount of 28.57 is included, because 28,571.43 was the amount of GST for 1,000 packets. So for 1 packet, it is 28.57, and the customer will not have to pay 100 plus 20.57. No, he is only bound to pay the MRP value of 100, which includes 28.57 of GST. So the department of the government has already got GST of 28,571 in the initial stage. Just go back a bit and we'll understand that this 28,471.43 was given by the wholesaler initially to the manufacturer. He will collect this and pay it to the GST department. The wholesaler will take this as input tax credit and he will collect 28,571 from the retailer, and that is what he's bound to pay. He will offset it or set off against ITC, and 0 is the amount that he'll pay to the department. The retailer also will collect 100 rupees from the customer, which includes 28.57 rupees for 1 packet of cigarettes. He will also end up paying 0 to the government because he can set off whatever he is liable to pay against the input tax credit that he could take for the tax that is paid to the wholesaler. This is the amount of ITC the retailer could also take. So ultimately, the government has got the 28,571.43 rupees at the initial first point of sale or supply chain itself. And at every stage when you calculate, because of the concept of input tax credit, you have 0 payment again to the government that is to be made. And finally, when the consumer is making the 100 rupees payment, MRP payment, he does not have to be charged GST extra on this because it is included. This 28.57 is included in the rupees 100 because it is already paid to the government in the previous stage. Now, so therefore, this was the method of RSP calculation or the valuation methodology to compute how much GST should be computed on this, how much GST should be calculated as per the advisory released by the government and effective from Feb 2026 for cigarettes and tobacco products. Well, I hope I was able to make things clear in this particular video. If you like the video, you could show support to us by hitting the like button. If you want more videos like these on a regular basis through your notifications, you could also click hitting on the subscribe button. Till then, I'll see you guys in the next video. Take care and thank you.